Now, let's see what are known as technical indicators. Other tools to be considered in technical analysis are technical indicators. These indicators are parameters to get buy and sell signals. They are obtained from a quantitative and statistical analysis of the time series of the stock prices. Some of the most used indicators are the simple moving average, whose acronym is SMA, the relative strength index, whose acronym is RSI. Another used parameter is the stochastic, the MACD, and the ones known as Bollinger Bands. In particular, we will discuss the simple moving average and the RSI. The technical analysts that use quantitative analysis as the primary working tool are known as statisticians. Let's see the first indicator that interests us, the simple moving average. The simple moving average is a parameter that represents the average stock price over a specific period of time. The simple moving average is calculated by using the formula we can see here. Applied to a candlestick chart, in this formula, P of I represents the stock price on the candle I, and N is the number of candles of the analyzed period of time. The most used moving averages are the ones of 50 and 200 candles. If the candles represent days, the simple moving average of 50 candles represents the average stock price over the last 50 trading days. On the other hand, the simple moving average of 200 candles represents the average stock price over the last 200 trading days. Here is an example of this technical indicator. It is important to mention that we do not need to calculate the simple moving average because in general, in the charts provided by our broker, we can also incorporate different technical indicators. As we can see here for the chart of Apple, the light blue curve represents the simple moving average of 50 candles. That means that the value indicated by the curve for a given time is the average stock price over the last 50 trading days. The signals of the moving averages are interpreted in the following way. Buy or hold if the price is above the moving average, and sell if the price is below the moving average. The simple moving average must be used only when the stock is in an uptrend or downtrend. It is not useful when the stock is in sideways trend. This is very important to note. If we are going to use the simple moving average, the stock must be in an uptrend or downtrend clearly. Moving averages can also be used as indicators of support and resistance levels. In this example, on the right side of the chart, we can clearly see that the curve of the simple moving average acts as support for the stock. Now, let's see the other indicator that interests us, the relative strength index or RSI. The RSI is an indicator that measures at each time the strength of the offer and the demand. Here's the equation used to obtain the RSI. It is calculated as 100 minus 100 divided by 1 plus RS, where RS is the average of bullish candles change divided by the average of bearish candles change. Remember that the change is the difference in stock prices relative to the previous day's closing price. Applied to a candlestick chart, in this formula, N is the number of candles of the analyzed period of time. The 14-candle RSI is commonly used. If the candles represent days, the 14-candle RSI uses the last 14 days of bullish candles and the last 14 days of bearish candles. As for the trading volume, in the stock charts provided by our broker, we can incorporate the values of the technical indicator RSI. In this case, we can see the curve of the 14-candle RSI below the volume area. RSI values range between 0 and 100%. At the level of 50% is the neutral zone, where the strength of the demand and the offer are equal. When the RSI moves away from the neutral zone and approaches 100%, it means that the strength of the demand is greater than the one of the offer. In this case, it is said that the stock is overbought and it would be the best time to sell. This sell signal is considered when the RSI is above 70%. When this occurs, it is said that the strength of the demand is excessive in relation to the one of the offer. So at any time, that buyer impulse may expire and become an offer that would produce a drop in the stock price. On the other hand, when the RSI moves away from the neutral zone and approaches 0%, it means that the strength of the offer is greater than the one of the demand. In this case, it is said that the stock is oversold and it would be the best time to buy. This buy signal is considered when the RSI is below 30%. In this image, in the bottom field of the chart, we can see the RSI. The bottom red line indicates the RSI level equals 30%, and the top red line indicates the RSI level equals 70%. If the RSI, represented by the violet curve, is below 30%, it indicates that the stock is oversold, that is, we get a buy signal. On the other hand, if the RSI is above 70%, it indicates that the stock is overbought, that is, we get a sell signal. So, according to the conditions previously seen to get a bullish signal, in order to increase the probability of the prediction, we will add the condition that the RSI is oversold, that is, RSI near or below 30%. Therefore, we will get a bullish signal when the stock meets the following criteria: stock price at support level or at lower channel line, increase in volume, and RSI near or below 30%. The first two were the ones we had previously seen, and now we added the condition that the RSI is near or below 30%. Let's consider the following example. Here we can see a chart of the Apple Company. On the left side of the chart, we can see that around $315 a support was formed, indicated here as support number 1. In turn, we can clearly see that at the time the stock touches this support, this is accompanied by an increase in volume and an RSI below 30%. Clearly, this is a strong bullish signal. On the right side of the chart, we can see what is indicated as support number 2. Notice that the first test of support is accompanied by a large increase in volume and an RSI below 30%, which was giving us a bullish signal. This rise in the stock price did occur. After it, the stock began to fall again, touching support for the second time. In this new test, we can see again an increase in volume and an RSI near 30%. So here we got another bullish signal. On the other hand, according to the conditions previously seen to get a bearish signal, in order to increase the probability of the prediction, we will add the condition that the RSI is overbought, that is, RSI near or above 70%. Therefore, we will get a bearish signal when the stock meets the following criteria: stock price at resistance level or at upper channel line, decline in volume, and RSI near or above 70%. The first two were the ones we had previously seen in order to get a bearish signal, and now we added the condition that the RSI is near or above 70%. In this case, we are analyzing the chart of the Amazon company. Notice that a resistance was formed at a value of just over $190. When the stock touched resistance for the second time, this was accompanied by a decline in volume and an RSI above 70%. Clearly, here we got a bearish signal. This fall in the stock price actually occurred in the following days.